Whoa, sometimes the universe is just a wonderful, beneficent place to be. And that's the way it is now. We are really rocking and rolling here. You're looking at Wall Street winners because you like to make the big bucks in the market. Let's dive right in, shall we? And oh my God, we could make so much money if we only could read all of this over and over again. All right. Stock market actually dipped a little bit, but not our portfolio, for the simple reason that we're long gold and we're long the right stocks. So I want you to look very closely at this picture here. So we saw the stock market drop off the last couple of days, but the purple predictor, that purple line, actually was getting bullish. Now let's take a look over here at the Dow. And you can see here that the buying pressure remains higher than the selling pressure. Although the jaws of the alligator did close, it remains slightly bullish. Very interesting price behavior. And finally, over here in the NASDAQ, this is the one that's getting hit the most. You see, the market, really since this rally began in March, has been led by the FAANG stocks. That would be like Facebook, Apple, Amazon, Netflix, Google, the big tech mega caps. And that's why the NASDAQ has significantly outperformed all other indices. But I think that's coming to an end. We don't see it here in the purple predictor, but when the purple predictor becomes bearish, that'll show me that the smart money is taking profits in the big FAANG stocks. Don't see it yet, but I do think that people are starting to say, wait a second, these stocks have gone too far, too fast. It's time for a retracement in those stocks. The stocks that I mentioned represent about 25% of the NASDAQ, so they dominate everything and have an outsized influence on the S&P as well. So what we're seeing is that we're getting to the point where these particular tech mega caps are so overpriced that it's going to be hard for them to move higher going forward. Now, several of them have earnings coming out this week. And I think what's going to happen is they're going to disappoint. And that's going to hurt the NASDAQ. It's going to hurt the S&P too, but it'll hurt the NASDAQ more. The good news is that we're in a stock picker's market. That is to say, I just went through our portfolio for our fully paid up members and saw that virtually every one of our stocks is up, even though the stock market was kind of crumbling a bit this last week. And the reason is because it's a stock picker's market. If you pick the right stocks, they're still in bull markets, even though the indices took a bit of a hit. Okay, let's take a look at our seasonality plays here. The top one is neutral. We're in the neutral period. The neutral period ends at the, really we start looking at it in September, but it really starts in October. So this is only going to stay neutral until then. However, we're in the bullish period, the normal bullish period for utilities. And you can see that they're climbing, but I don't want to buy them until they break above the high that we made in June, at which point I'll flip the switch and we'll turn our utility indicator to bullish and I'll buy the Utes. We're right now, we had that little crumble last week. Remember that look at the seasonality tells us we should have expected the little crumble. But this week we should see a rebound in all of the indices. So look for the market to turn around here, maybe not on Monday, but soon afterwards, and start to rally higher. The Fed remains targeting the yield curve, but notice that the yield curve is drifting slowly down. Now, that's not because short-term interest rates are going up. It's because 10-year treasuries are going down. The yield are going down. And, of course, we're long TLT, so we're making a little bit of money. And I think that's going to continue. The Fed has a bias towards lower interest rates, but believe it or not, lower interest rates isn't what motivates people. It's the shape of the yield curve. Very esoteric here. All right, we saw a little bit of a dip in asset allocation, people running for the hills a little bit, no big deal. We're seeing the stock market risk indicator, though it bounced up a week or so ago and it's staying up there. So they're saying, yeah, we'll take a little more risk. It's okay. Global stocks look pretty good. Look at that. They broke to new highs. I think that shows that we're starting to see the foreign stock markets outperform the basic U.S. stock market. That gets me intrigued. And so maybe next week I'll start to be focused, or this coming week I should say, I'll start to focus on some foreign markets to buy. Bonds. This is what I was talking about. The Fed is letting the 10-year Treasury bonds rally. Purple Predictor remains bullish, and we're long bonds, and we're not going to make a lot of money on this trade, but if the market were to go into, we'll make a little bit of money, and if the market goes into a bear market, we'll make a lot of money. So I think this is strongly asymmetrical in our favor. The indicators say that interest rates should be higher. Gold higher, CRB higher, 10-year treasuries, but the Fed is manipulating them lower. Well, guess who's more powerful? The Fed, massively distorting and manipulating interest rates. Dollar under significant pressure here, mainly against the euro, but we even saw the yen start to crack, and of course a bunch of other currencies as well, but mainly the dollar is cracking hard now, and you can see we broke the lows we made in March, which were multi-year lows to begin with. So if the price of the dollar is plunging, what does that mean to our gold position? Ha 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 ha. He laughs evilly. Skyrocko-rama. Look at that. Pop, pop, pop. That's really helping our portfolio out nicely. All right. Our indicators also turn more bullish. So all three indicators are now bullish, although Chris, who helps me with this, he's only counting the middle one as a half bullish. Nonetheless, all three are bullish. Okay, crude oil creeping higher. I guess, you know what, I just don't feel, sometimes I'm totally wired into this market. And I mean, really, nobody's called this market better than I have this year. But I'll be frank with you, the last couple of months, I've been sort of going like, I'm not really feeling it. I'm not feeling it. My fundamental analysis is kind of, my crystal ball is, it's a little fuzzy. Okay, and Bitcoin did nicely this week, I think, as a bit of a hedge, and the purple predictor picked up. So I think I'm going to remain on the bear side here in Bitcoin, but this week's price action was pretty good. We broke to new mini highs, and so we're making mini highs and mini lows. By definition, that's a mini bull market. So I don't want to be short, as I mentioned, I mentioned now for a couple of months. I don't really want to be short here. But if I had to be anything, I'd be short. I think the best thing to do with Bitcoin right now is to not trade it. Okay, I've got coming up on Wednesday, I'm doing a live webinar on the bear market, a complete up-to-date, more information, better timing, more strategies. So just send an email to support@wealthbuilderllc.com and get a free ticket to that, okay? It's free, so, hey, you can't beat the price. All right, freebies. You know we love you having you here. Fully paid up members, hang on just 1 second.